When it comes to transfers to minors, custodial accounts are the lowest hanging fruit. However, there's special care that needs to be taken as to who acts as custodian and how the income of the custodial account is used. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 226, explores some pitfalls with custodial accounts. We'll look at some various IRS revenue rulings, especially Revenue Ruling 70-348, in support of our exploration of should a donor be a custodian or become a custodian. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So why do I do what I do? It's because I love speaking and teaching. That's my passion. So if you'd like an in-person or virtual speaker for your firm, organization, or event, please email me at griffin.bridgers@gmail.com. Back to our presentation. So, children who are unemancipated minors lack the authority to enter into contracts. So because of that, they can't own a bank account or an investment account or securities or real estate or anything like that. So for most forms of wealth, if you wanted to make a gift to a minor child during life, you would need to set up a custodial account for that minor child. And these accounts are authorized in pretty much every state through the adoption of either the Uniform Gifts to Minors Act or the Uniform Transfers to Minors Act. You see various flavors of each in pretty much every state. We won't dive into these accounts in detail, but the general setup is that you have a custodian of that account who's kind of like a trustee who manages that account for the child until the child reaches the age of 21, at which point the child can raid that account and become the owner. Now that has its own issues and significance in the estate planning world, which we won't touch on, but with custodial accounts themselves, you need to explore the gift tax issues if you're looking at funding one with a gift during life. Since the child can't receive the property until age 21, it appears that the possession or enjoyment of the property is deferred until the child reaches that age. So this makes the transfer to a custodial account at first glance look like it would be a transfer of a future interest. And while this is esoteric, any transfer of a future interest wouldn't qualify for the gift tax annual exclusion of $15,000 per donee that's given to a donor for gift tax purposes. However, there's a specific carve-out under Code Section 2503C, which essentially treats transfers to minors under a custodial account or under the trust equivalent of a custodial account as qualifying as a present interest. So, in that case, you could use your gift tax annual exclusion for a gift to a custodial account. And you could even double it through a gift splitting election with a spouse, in which case, regardless of who writes the check, all calendar year gifts to donees other than the consenting spouse would be treated as being made one half by each spouse in that case. So for example, here you could have one spouse write a $30,000 check to a custodial account, but file a gift tax return where the non-donor spouse signs to consent to split gifts, and in such case, each spouse would be treated as making a $15,000 gift, combined total of $30,000, and each would use their respective gift tax annual exclusions. We'll talk about the significance of that in a second from an estate tax perspective, but for the time being, when you make a transfer to a custodial account, typically it's treated as a completed gift in pretty much all cases, which would usually not be subject to estate tax at the donor's death. However, this is not the case if the donor is a custodian of the account at death, and the death occurs before the child reaches the age of 21. So in such a case, what happens is the donor, in this case, has retained powers equivalent to a trustee by acting as custodian, and that will cause the donor to be treated as the owner of that property under Code Sections 2036 and or 2038. So the effect is that the value of the custodial account at the donor's date of death would be included in the donor's estate, which would include the date of death, fair market value, and any annual exclusions that were previously used to make a tax-free transfer, and the appreciation in the value of the property that occurred after the gift. So otherwise, if the donor is not the custodian, then the property will be that of the child for all purposes. So if the child were to die, regardless of their age, they would be treated as the owner at death for estate tax purposes. Now, what's the solution here? How do we get around this? Well, the easiest solution is to just simply make the non-donor parent the custodian of that account. And if that's not a practical solution, you could pick some other family member. So what I'm going to work in is the sphere of we're assuming that parents are working together and are married or whatever the case. But the problem is, what if that non-donor spouse or parent ceases to act as custodian? Who's left? Well, it makes sense in that case that maybe the original donor parent would step in and become a custodian. If they weren't from the inception, it makes sense that maybe there wouldn't be an estate tax issue. They're really kind of stepping in due to necessity and not due to any sort of plan to avoid estate tax. But in that case, even though the donor wasn't the custodian from the outset, if they step into that role and are still serving in it at the time of their death, before the child reaches the age of 21, Code Section 2038 would kick in. And that would cause the donor to still be treated as the estate tax owner of this custodial account like we just looked at in the last slide. And this was the result reflected in Revenue Ruling 70-348. Now it's important to note there's a fine distinction here that's not necessarily covered in the Revenue Ruling, but which you should know. That's that Code Section 2038 only looks to powers that you hold at death, whereas 2036 looks to powers retained at the time of gift and still held at the time of death or released within 3 years of death. So what 2038 is designed to do is to keep you from end-running 2036 by not being a custodian at the time of the gift, but later becoming a custodian at the time of the gift, or at some later date after the gift occurs. So, what about gift splitting? We talked about that briefly back on the gift tax discussion, and recall that this treats the gift as being made one half by each spouse. So you'd have the non-donor spouse also being treated for gift tax purposes as if that non-donor spouse contributed one half of the balance of that custodial account. Now I use the term spouse instead of parent here because the gift splitting election is only available to married couples. Now, it seems intuitive in this scenario that the non-donor spouse could not be the custodian, at least with respect to that one half that they are deemed to contribute under the gift splitting election, if you want to avoid the estate tax issues that we've been looking at. However, the good news here is that's not the case. Revenue Ruling 74-556 allows a non-donor spouse who consents to split gifts to serve as custodian because, in that case, what the IRS says they're focused on under 2036 and 2038 is an actual paper transfer for state law purposes and not necessarily a deemed transfer for gift tax purposes. So that has universal application in a lot of scenarios where a gift splitting election could be used for any variety of transfers, maybe in trust or otherwise, where the non-settlor spouse could act as trustee, even where there's a gift splitting election. Now there's a few tidbits too you need to recognize on income tax, and this will kind of tee up a later discussion we'll have looking at trusts themselves. So, a child is usually taxed on the income of their custodial account subject to the kiddie tax rules. However, there's a carve-out, there's an exception that says regardless of who the custodian is, if there's a parent or guardian who has a legal obligation to support that child and that parent or guardian uses the income of the custodial account to discharge their legal support obligation during the year, then that parent or child will be taxed on that income. There's a bit of a typo here. It says the donor will be taxed on the income, but that's not, it doesn't have to be the donor. It could be the parent or guardian, regardless of who the donor is, using that income to discharge their legal support obligation. So that was reflected in Revenue Ruling 56-484. So, long story short, if you're a parent or guardian, whether or not you've created a custodial account, you should use your own assets to support your children, especially your own income. Now, This is going to kind of tee up a later discussion because one common error I see in a lot of estate plans is a scenario where maybe a child's trust is created and you name a guardian for a minor child, but you also name the guardian maybe as a beneficiary of that child's trust or as a trustee of that child's trust. Well, the same type of rule could backdoor in and cause all sorts of tax issues that a lot of drafters are not aware of. But like I said, that's a topic for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. As a reminder, I cannot give legal or tax advice in any questions that you do forward to me, so please don't ask specific questions relevant to your scenario or abstract questions which are really designed to end run and be a question about your specific scenario. As always, thank you for joining me for this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.